Welcome to today's video. I'm Michael Neuenswander with Outlook Wealth Advisors. Today we're going to talk a little bit about taxes, charitable planning, and your estate when it comes to your overall retirement picture. So let's start off with this idea of taxes in retirement. In a previous video, we've gone into more depth about really different tax strategies and how to plan for retirement. But if we keep it high level and simple, when we talk about addressing taxes in retirement, for most people, the majority of your investment assets may be in retirement accounts, IRAs, 401ks, 403b, etc. And ultimately, as you take that money out, you've got to pay some taxes on it. So if we kept tax strategy or tax planning at a very high level and simple definition, really the name of the game is to say, if you have to pay some taxes on some of that money, when is the cheapest time to do it? Is it going to be early in retirement, prior to decisions around Social Security or required distributions? Does it end up being later in retirement if perhaps you're still working or you're doing a phased retirement or retirement in which you're still working part-time, so income is elevated? And then what happens when you have required distributions, so income may be going back up, or heaven forbid, a loss of a spouse, and then you're on a single taxpayer return instead of a joint tax return. So as we also look at where taxes may go in the future, and it says, given the state of spending in this country and saying neither side of the political aisle has really gotten real serious about cutting expenses, my professional opinion is that taxes will likely get worse down the road than better. So when we line up where taxes may go in and take into account your own personal tax and income situation, really, tax planning in retirement is saying if you have to pay some taxes, when is the cheapest time to pay it, and how do you get those paid for a little less dollars, but a little less today actually ends up being a huge amount when you look at what that can save over the course of your entire lifetime. Now, in today's video, we're going to dig into a few more subjects that really have to do with some of the nuances of that tax strategy. So the first topic we want to address today are what are called qualified charitable distributions, or QCDs, as they're known. What a QCD is it allows you to take a distribution directly from your retirement account and give it directly to the charity. Now, directly is the key word that I mentioned there. It doesn't go through your bank account. You never touch it per se. That check is made directly from your custodian, wherever your retirement account may be held, directly to that charity. Now, the benefit of a QCD, or that qualified charitable distribution, it comes out of your IRA, but it does not count as income to you at all. Now let me rephrase that, or let me make sure you heard it properly. Comes out of the IRA, but in effect, you're getting an 100% immediate tax deduction because it does not even count as income. And when we go through how things are taxed in retirement, whether it be the taxation of your Social Security, whether it's what you pay for Medicare via IRMAA, having something not show as income is actually much better than having it show as income and then trying to see if you can deduct it later. Now, for a married couple filing joint today, their tax deduction is about $32,000. If they're over 65, again, indexed for inflation, but it says for most people, you're not giving away anywhere near that amount. So for most people, even when you give money to charity, you're not really getting a tax deduction anyway. So the QCD is a much better method for most people to give money to charity. Now, there are a few gotchas, a few rules, of course, you have to play by. The QCD does not apply until you're age 70 and a half. And again, let's make sure I'm clear, even though they've moved required distributions, which we'll touch on in a moment, to age 73 and beyond, the qualified charitable distribution still applies at age 70 and a half. But they are very specific about that. It is not the year you turn 70 and a half, it is 70 and a half and beyond. So for many people, as you approach that age, one strategy may simply be, do I hold off on some donations, either the end of the year before, or if your birthday is later in the year, do I hold off on donations prior to the being 70 and a half and simply load up on the back end or once you've turned that age? Another important aspect of QCDs when it comes to your overall retirement and tax strategy, though, is sometimes when people think about what is called a Roth conversion, or moving money from their retirement account over to the Roth to a tax-free side, some people have this mistaken notion, well, should I try to move my entire IRA account? I would tell you that most of the time, if you try to move your entire IRA account over to a Roth, you've probably overpaid in taxes somewhere along the way. And this QCD is a prime example, meaning If you're giving any money to church or charity throughout your retirement, why would you take that money out of an IRA account to move it to a Roth and therefore pay the taxes versus simply leave the money that you were going to give to charity anyway in the IRA? By having the IRA then write that check directly to those charities, you're not paying taxes on it anyway. The charity, of course, does not pay taxes. So moving money out of an IRA that you're planning on giving away becomes a mistake when it comes to retirement planning. So QCDs are a great tool for those who are giving some money away or charitably inclined once you're age 70 and a half and beyond. But there's another strategy that applies before age 70 and a half. That's what's called a charitable fund or a donor-advised fund. What this really means is it gives you the ability to add up several years' worth of donations, but take a tax deduction all at once. The standard deduction for a couple age 65 is upwards of $32,000 and indexed for inflation, going forward. Most people, if they're not giving away significant amounts of money, are never getting above that standard deduction. So what that donor-advised fund allows you to do, can you stack up several years' worth of donations, and simply by earmarking it or putting it in a separate fund, a separate account today, you're allowed to take that tax deduction for the entire amount. So for example, if a couple was giving $10,000 or $15,000 away to various church or charity throughout the year, that's generally never enough for them to actually get a tax deduction for it. But by doing so and saying, let's add up 2, 3, 4 years worth all at once, they now have a deduction that may be $30,000, $40,000, $50,000 on top of their normal deductions like property taxes and other things. And so that may be enough that it saves them a significant amount of money. When we pair that strategy up, perhaps with Roth conversions as well, it becomes a strategy to say if we're going to recognize some extra income by converting some money from your IRA to a Roth, can we effectively make that income disappear off the tax return by having a large deduction completely offset it? So the donor-advised fund is a strategy to use when you're trying to create extra tax deductions, and perhaps simply using the money you were going to give to charity anyway, but never get a tax deduction for, and taking one step farther, maybe even purposely doing a Roth conversion that same year to offset those taxes. Now, in pairing those two up, what's called a qualified charitable distribution, which applies after 70 and a half, and a donor-advised fund, which applies before age 70 and a half, a strategy for people that are charitably inclined may be, do I take however many years you have before age 70 and a half? Let's take somebody who's 65. Can you set aside 5 years worth of donations today and have a huge tax deduction? You give from that donor-advised fund on the same schedule you were going to give anyway. So that's another key difference. You're setting the money aside today. You're not actually giving it away today. You can decide each and every year how much do you give away to which charities, etc. But you can do that prior to 70 and a half, and then at 70 and a half, you switch to the QCD. Those two strategies combined may be a great tool for individuals or a couple who are giving money to church and charity anyway, but not getting any tax benefit from it. So when we talk about taxes and charitable giving and estate planning and retirement, there are a couple other considerations we also need to take into account. So gifting is one of those areas that also gives some confusion, because many of us think, well, if I simply leave things to loved ones, to kids, etc., that's one way of doing it. Once I'm gone, they just get whatever's left. However, you are allowed to gift during your lifetime, as well. And the way the gifting rules work, there's often some confusion around it. Most people are familiar with what they call an annual exemption. And today, that number is about $18,000 per person. And what that means is you could literally give $18,000 to anyone you want. You don't pay any taxes to do it. They don't pay any taxes to receive it. There is no tax reporting whatsoever. In a married couple, you're allowed to actually split that donation, or in essence, double it. It can be $18,000 from each spouse. So if part of your plan that says we wanted to go ahead and help out kids or help out loved ones, you could give them $36,000 every single year with no tax implications, no reporting whatsoever. But here's where things get confusing. If your money is IRA money, that's a common misconception. Can I just give them part of my IRA? Unfortunately not. It says you have to take money out of the IRA and you have to pay taxes on it first. Then you could gift the residual, in that manner. So unfortunately, IRAs are not exempt, or the gift tax rules do not exempt the taxes coming out of retirement accounts. But the other question that often comes up is, well, what if I wanted to give more than that? Well, you can actually give much more than that. In today's environment, you can actually give all the way up to your lifetime exemption, which today is in excess of $12 million. So for most people, you could look and say gifting is virtually unlimited. Same rules around an IRA apply, though. If it comes out of an IRA, you got to pay the income tax first. But what happens when you want to gift and use up part of your lifetime exemption, you're simply required to file a tax form. You're letting the IRS know that you gave more than that $18,000 per person. Therefore, you file the gift tax form. You're utilizing or using part of your lifetime exemption. And in today's environment, that has very little impact for most people. However, there is a word of caution when you talk about using a lifetime exemption. While you're using the exemption based on today's exemption amount of that, almost $13 million, when they change the tax law, what will really happen is they'll go back and look at everything you've gifted over your lifetime, and they're going to apply it to whatever the current exemption is. So I'll use an extreme case. Prior to this tax law change, where the exemptions got up to be $12, $13 million, it was only a $13 million exemption. Prior to that, it was only $1.5 million exemption. Suppose over your lifetime you wanted to give the kids, $500,000 early. You can do it. You're going to use that lifetime exemption. And if tax laws never changed, you would say, well, you still have roughly $12.5 million of exemption left. But fast forward, says upon your passing, what if that lifetime exemption is now only back to $3 million or $1.5 million? That $500,000 you gave away is applied against that exemption at the time. You don't actually get credit for the fact that the exemption is much higher today. So that may be an area that it obviously does not apply to everyone, but it's critical to understand if you're thinking about making significant gifts that are not to charity. You need to understand, how does it work, not just today, but what does it look like in the context of your entire retirement plan? And could it cause some unforeseen estate tax issues down the road by not quite understanding how all the pieces fit together? One other critical area we want to touch on today when it comes to taxes, estate planning, overall retirement planning, has to do with your required minimum distribution. Previously, we touched on this term called a QCD, a qualified charitable distribution. And we mentioned that those start at age 70 and a half, while today the required distribution for most people begins at age 73. For people that are a little younger, that may actually push out to age 74 and 75. But one of the big things about your required distribution, the first required distribution you have to take starts at approximately 3.7%. And it's 3.7% on your total retirement assets. Not your non-retirement money, not your house, but IRAs, 401ks, 403bs, all those retirement accounts. In a previous video, we talked about the strategy of doing Roth conversions. So I will point out Roth IRAs are exempt from required distributions under the current law, but all other retirement accounts count. One other little asterisk, if you're still working, your current 401k is exempt from a required distribution up until you retire. But it doesn't mean you can necessarily go put all your money back into the current 401k. They're looking at the part that's based on current employer. So as we look at required distributions, as I mentioned, the first year, only 3.7%. But every year you get older, that percentage that they make you take out gets larger and larger. So by design, your required distributions over time continue to grow. For many people as well, if you look at what happens if you're married today and filing a joint tax return, the other consideration, if one of you were to pass away, that required distribution then just simply transfers to your spouse, assuming they are the beneficiary of your account. They have to continue that required distribution, but now they have to continue it on a single payer tax return, which means their taxes likely went up, not 5 or 10%, but in many cases more like 20 to 30% because of that increase. So here's where QCDs, become a tool for required distributions. Those qualified charitable distributions actually offset your RMD. What I mean by that is if your required distribution, let's say, was $30,000 a year, but you were giving away 7 to 8, if you use the qualified charitable distribution method and give that $8,000 directly from your retirement account to that charity, it fulfills your required distribution, but that $8,000 does not count as income to you. So once again, by not counting as income, that may potentially save you money on some of the taxation on Social Security. It may keep your income lower so that you're not subject to IRMA or extra charges on your Medicare premiums. So QCDs for many people potentially should be the preferred method of giving any charitable donations after age 70 and a half, but perhaps certainly once your required minimum distribution age as well. So I hope today's video is helpful. Today we touched on qualified charitable distributions, or QCDs, what are donor-advised funds or charitable funds and how those work, as well as the impact of required distributions when it comes to taxes and your overall strategy. For more information like this, make sure to subscribe to the channel, or if you have specific questions on things we touched on, such as Roth IRAs, Roth conversions, make sure to check out our other videos or simply contact us at info@outlookwealth.com.